Guys, Raymond here with another video. We're going to be analyzing the next company in our list of German materials companies. So it's Evonik Industries. Let's check out the chart. So as you can see, it's red over its lifetime. When did it start? It started trading 2013, early 2013, and up to this date it's lost 12.52% of its original value. I invested £1 and it's the value of my investment has decreased by 4%. Let's look at the employee figure is 32,000, almost 33,000, which shows it's definitely a large company. It's a 13 billion euro company. The price to earnings ratio is 22, which is okay. It's double the average figure we're looking for, or the great ratio we're looking for. But 22 is definitely not a bad case. So earnings per share is 1.26 euros compared to the market price, 27 euros. 1.26 is not too bad. It's better than the last company that we looked at. Revenue figure is 12 billion euros compared to the market cap, which the revenue figure is close to the market cap, which is decent. But of course, the most important thing when it comes to revenue is the net income or profit margin. So let's look at the dividend yield before we look at net income. Dividend yield is 6.16%, which is actually really good. It's above the 5% minimum. The beta is 18% over the market average, which still is not very high, which is good. It's anything above 2 or anything about close approaching 2 is quite risky. Let's look at the income statement. 3.81% profit margin, which is close to the retail average. Anything below 5%, I'll say anything below 10% is not very good. It's quite dangerous. Regardless of how much debt the company has, if the company has high debt and a low profit margin, that's just a recipe for disaster. So looking at the balance sheet, the debt to asset ratio is 61%, which is over 50%, which is the minimum we look for. 61% is really high, so that's going to really do some damage to the overall net income or profit margin. So let's look at lastly the net change in cash. Hopefully we'll get some positives. As you can see, it doesn't include the current financial year, but looking at the previous financial year and the 2 years before that, first is a negative 602 million, which is quite a lot to lose. And the previous year 177 plus, the previous year negative 16. So overall it's over, let's just go look at that again, 150. So it's almost a negative 800 million. So that's quite a lot to lose in at the end of 3 years, especially considering that the market cap isn't so high. So overall, this company, the positives are its dividend yield. I would say it's beta, but its beta is 18% above the average. So let's just stick with the dividend yield. The dividend yield PE ratio, I'd say, is a lot higher than the minimum we look for. So I would say the size of the company and its dividend yield are its 2 pluses, as well as the employee count. Apart from that, the company, I would say, is not a good investment. It's not a strong investment, so I would pass on this one. Thank you so much for watching. I will see you in the next one.